This was the first time a government explicitly calculated the value of labor and capital. But Hammurabi didn't stop at wages. He went after the most dangerous industry in the world. Healthcare. Getty Images. Explore Law 215 sets the price for a life-saving surgery. If a surgeon saves the life of a free man and a melu, he is paid 10 shekels of silver. That was a fortune, roughly a year's wages for a common worker. But here is where the eye for an eye logic enters the economy. High pay came with lethal risk. Read that again. If you kill the patient, you lose the hands that hold the knife. Hammurabi believed that if you wanted the prestige and the high fees of being a doctor, you had to accept total liability for your failure. There was no malpractice insurance. There were no lawsuits. There was only success or mutilation. 610. The interest rate cap. But the biggest threat to Babylon wasn't bad doctors. It was bad bankers. Silver was durable. It lasted forever. Grain was perishable. It could rot or be eaten by rats. Hammurabi understood that lending grain was riskier than lending silver. So he created the first central bank interest rate cap. If a merchant lent silver, the maximum interest rate was 20%. If he lent grain, the maximum was 33%. He baked the risk premium into the law. And the penalty for loan sharking? It wasn't a fine. If a lender tried to charge more than the legal limit, or tried to trick the borrower with complex accounting, the law was clear. He forfeited the entire principal. He lost. Everything he lent. Hammurabi knew that unchecked compound interest would destroy his society. He knew that if the farmers lost their land to the bankers, nobody would be left to grow the food. So he created a safety valve, Shutterstock. Explore. In the ancient world, there was no credit score. Your collateral was your body and the bodies of your family. If a man couldn't pay his debts, he often had to sell his wife or children into slavery to the creditor. It was a brutal, dehumanizing system. But Hammurabi saw a systemic risk. If all the citizens became slaves to a few rich merchants, the king would have no army and no tax base. So he wrote Law 117. It states, if a man creates a debt and sells his wife, son, or daughter for money, they shall work in the house of the purchaser for 3 years, but in the 4th year they shall be set free 3 years. That was the limit of liability. The creditor got 3 years of labor to recoup his loss, and then the debt was wiped clean. This was the ancient version of Chapter 13, bankruptcy. It ensured that a temporary financial mistake didn't become a permanent life sentence. It reset the economy. 850. The principal agent problem. The code also solved one of the trickiest problems in modern business. How do you trust your employees? Babylonian merchants would give goods to agents to sell in distant cities. But what if the agent sold the goods, pocketed the cash, and claimed he was robbed by bandits? Hammurabi had a law for that. Law 104 mandated that every transaction required a receipt. No receipt, no legal standing. If the agent claimed he was robbed, he had to swear an oath before the gods. If he was telling the truth, he was acquitted. Law 103. But if he was lying, the penalty was severe. He had to pay the merchant back threefold. But watch this. If the merchant tried to cheat the agent, if the merchant denied receiving the repayment, the merchant had to pay the agent sixfold. The penalty for the rich man cheating the worker was double the penalty of the worker cheating. The rich man. Hammurabi penalized power. He knew the merchant had more leverage, so he held him to a higher standard of honesty. Now we have to be realistic. The code of Hammurabi was revolutionary, but it wasn't perfect. It had a massive economic blind spot. It completely ignored the law of supply and demand. Hammurabi set prices in stone literally. But what happens during a drought when grain is scarce? The market price should go up, but the law said it had to stay the same. This likely caused shortages, black markets, and economic inefficiency. He was operating on a just price theory, the idea that things have a moral value rather than a market value. And of course, the punishments were barbaric. We don't cut off surgeons' hands anymore. We don't drown wine cellars for watering down the beer, but we have to ask ourselves, have we swung too far in the other direction? Today, if a banker makes a risky bet and destroys the economy, he gets a bailout. He keeps his bonus. He keeps his hands. Under Hammurabi, that banker would have faced the ultimate penalty. We have built a financial system that privatizes the gains and socializes the losses. We have removed the skin in the game. Hammurabi ruled for 43 years because his people believed the system was harsh but fair. They knew that the same law that punished the slave also capped the greed of the master. So as we look at our own economy, loaded with $35 trillion in debt and interest rates that punish the poor, maybe we should look back at that. Black stone in the Louvre. Maybe an eye for an eye wasn't about cruelty. Maybe it was about balance. Which system do you think is actually more just? The one where the builder dies if the house collapses? Or the one where the builder gets paid to build it again? I want to see your arguments in the comments. And if you want to understand how the Knights Templar invented modern banking and got burned at the stake for it, make sure you're subscribed. We're revisiting that history next.